Welcome in Venugopal Garre as well. He's India Head of Research at Bernstein. Venu, good morning. Great to have you with us here. Thanks very much for joining us. Venu, the simple question is, how much is in the price and how much is not across sectors, across mostly consumption sectors? Rates are either flat or they're lower across the board. How do you think about this question? How much will this do to increased affordability as a fillip to consumption? Venu, go on.
Yeah, thanks, Prashant. Everything in life is relative to what it was earlier. So that's a broader principle I use. So if you were to look at consumption in general across the board from a broad-based standpoint, from an economic data points perspective, things have not been that great in the last couple of years, while we've essentially seen the other parts of the economy, including industrials, capital expenditure, essentially being the ones which have led the last few years. Now, what is essentially happening is broadly a forced policy push towards consumption. And this is not the first point at which this is being pushed. We've been sort of seeing the change in theme from the fag end of last year with the direct tax cuts announced with effect from April, a $15 billion sort of a positive cash flow to the middle class, which is a recurring annual sort of a cash flow. And on top of that, you have this GST impact, which purely from product standpoint, when we look at the impact is more than $20 billion. I'm just ignoring anything on the services side, which again is a pretty large number. Remember, that doesn't stop at this. We also have pay commission impact, which is a pretty large number again next year. Lower inflation this year in the second half of the year, lower rates, higher liquidity in the system. All of it broadly needs to be factored in when it comes to the potential positivity when it comes to consumption relative to every other sector. So that's the way I would look at it. At the margin, incrementally, the sector would outperform. Quantum-wise, of course, remember that the limitations, if at all, would be the fact that economy in general hasn't been that great. And plus, you have the export impact, which might sort of impact a bit of jobs here and there. We need to negate that as well. So these are the counterbalancing sort of aspects to the extent to which you will see a push.
By the way, I just want to point out that the market today, today's level of the Nifty is a couple of notches lower than where the market closed on the 18th of August. And why do I talk about 18th of August? Because that's when the market reacted to the announcement, Prime Minister's announcement, which was made on the 15th of August. The market that day closed at 24,876, exact number on the Nifty, 876. Today we're at 852. And Venu, that's my question. So much positivity has been thrown at the market. This big, government spent a lakh crore, right? That's the revenue loss from these GST cuts. And there's hope of a good festive season, good monsoons. But why is the market in such a funk? It's simply sort of refusing to see or get too excited about the positives. So what do you think this is? Is it just because of the extent of selling? Or what's happening here? Why not the kind of excitement that you would anticipate after a move as big as this one?
The way I would look at it is that the economy has not been very strong for almost a year. Ignore the base effect aberrations and catch-ups, which led to a recovery in the March and June quarters. But on a broad basis, domestic economy has been weak. The second main part is, of course, you're still seeing some concerns on the geopolitical side of things, the overtures India is trying to do with China, US-India relationship spoiling. We've essentially moved to a 50% tariff. After the GST announcement, 2 weeks later, we had moved into that higher tariff rate. So putting all this into perspective, remember that a lot of what is essentially happening on the policy front are offsets to economic weakness. And of course, what we are seeing today is slightly larger than an offset, but the reality is it's only neutralizing some bit of the negative impacts. The other thing, remember, is purely from a flow perspective, there are two main things to note. One is we've not essentially seen EM money or FII money essentially too excited about India. Part of that is because there were great opportunities elsewhere. And more importantly, economically, things were a bit more weaker, along with valuations being higher. So that is something which needs to reverse in the second half of this year for you to see markets to go to higher levels. And we do believe later in the year it would, because once all these moves essentially lead to an improvement in the economy is when you essentially see FII money flow in. And whatever domestic money is flowing in, you're also seeing the IPO pipeline as well accelerate. So there's a lot of selling as well happening in both the primary and secondary markets, which is sort of digesting that bit of a flow. So it's a combination of all that. I wouldn't really worry too much about it 6 months from now, but don't expect any immediate gains just because of this move.
Hi, Venu. Good to see you, Ben. No, but it's encouraging to see at least the centre taking note of the slowdown and acting on it. And monetary policy as well has been pro-growth. So I think both those two at least, they acknowledge the problem and trying to do something about it. That said, the two big beneficiaries, going by the reactions on the stocks, going by what most brokerages are saying as well, autos as well as FMCG. Now, FMCG actually, the staples part of it has underperformed. How do you approach that pack? What do you like from FMCG, the discretionary spend, or do you think staples as well, you'll give it a look? And from autos, which category do you like?
Okay, so, on an overarching basis, when we headed into this year, we had a change of view in terms of how we positioned our sectors. So this was the first ever year where we had consumption overweight on a broader basis relative to industrials. Now, within consumption, FMCG as a space, I had upgraded about, I would probably say 1.5 to 2 months back. And that is a sector which is essentially underperformed for a fair bit of time because of volume growth concerns. This is a space, I guess, given what has happened to GST changes today, is a positive surprise, honestly. I didn't really expect some of those categories to move to 5% rate, especially when things like shampoo, soaps, I thought probably it'll be still at 18. So it is a positive surprise. So FMCG pack in general, I guess, still has some legs because it's not really done well in the last couple of years. Within the small value discretionary, I think we shouldn't miss out on that fact, which is durables and other areas, ideally should also see some degree of lift in terms of demand. Remember that just because a consumer is saving, let's assume the $20 billion number based on whatever he was purchasing earlier, that money doesn't need to go into the same sector. That could perhaps be used for buying any other product, or maybe even invest or repay debt, whatever. I mean, from a quantum standpoint, one can discuss. So that is a very important factor as well when it comes to taking an overarching view on consumption rather than a particular category. Yeah. Coming to autos, very clearly, it's a benefit across the board for ICE players versus EV, because the gap between EV and ICE tax rates are narrowing. And within ICE, we've been in general positive on small cars, which has essentially seen a run. We're also positive on the tractor sort of / SUV space. So these are relatively more preferred rather than an entry-level motorcycle, because we do believe that wherever penetrations are lower, there'll be a larger propensity to see a broader volume impact, as against sectors where penetration is already high. You should ideally see a lower impact in terms of volumes. So that's a broad way I would put it.
I just want to quickly highlight that if you look at the auto space, right, it is Mahindra at one level, everything else is far below. Eicher is also just up about 2.5%. Mahindra continues with its 7% pop, not very much else really in a big way, which is sort of starting to show through.
And on auto, the actual beneficiaries, or the ones that were supposed to be big beneficiaries like Maruti or Hyundai, the stocks have also not moved too much. Those stocks are up between 1.5%.
So it's a sad thing, but as someone said, and I think it makes sense, right, that like at the lower end of the EMI difference, for example, a Alto or the entry-level kind of cars, the EMI difference is so small, it's actually a few hundred rupees on a typical auto loan. So if you could not afford a EMI, for the entry-level car before, would a few $100 make a difference to push demand?
Yeah.
Right? That's the. I think it's a relevant question to ask. Hopefully it does, but I don't know. Yeah.
No, absolutely. And in fact, I was going to ask Venu exactly about this, about financials and the way we need to think about it. Because, of course, Bajaj Finance is a clear beneficiary straight out. But overall, on financials, would you expect...
I think Venu wants to say... Venu, you want to add something? I can sense that you want to come in. Go on, Venu.
I just loved your comment on the quantum of EMI impact. If you were to extrapolate this to every product category, then there's going to be zero impact on anything. So a 20 rupees soap, why should somebody buy? Because it's 2 rupees cheaper, right? So I think we need to look at it from a broader context of.
No, you're agreeing with me, or you're being sarcastic, Venu?
I'm being sarcastic with you, not to the market.
Sorry, what is that?
I'm being sarcastic on your comment rather than on the market and the benefit. I do believe you need to think of. Need to look at things from a very holistic overall impact perspective, right?
So
this $20 billion number is, I don't want to nitpick on particular categories. Honestly, 100 to 200 rupees saving is very meaningful for a particular individual who's buying a two-wheeler. Yeah. A 5 rupee saving might be quite meaningless across the board on a soap for anyone, right? So, but the saving is a saving, right? And it's going to feature somewhere in terms of some incremental volumes. That's the way I would probably present it. And also remember, Prashant, that Maruti.
No, Venu, my point, the point is you're aggregating all the savings, and that is saving in the hands. It'll go somewhere. But my only point was, can you say this segment is where it's going to see a bump up? I mean, exactly. That was my point. So for exactly entry-level cars, will demand go up significantly because you got a couple of hundred rupees in terms of EMI savings?
But the price of the car
I'm not sure.
itself is down 10%, right? We have to take that on board as well. That the price itself, if it's passed on entirely, like Eminem said, the price of the product does go down by 10%.
That's what I'm saying. Yeah. But calculated as EMI.
As EMI.
It's 700-800 rupees.
Yeah.
That is my point. I'm saying, will it really move the needle for that product category? I'm not sure. Go on.
Prashant, fair point. In fact, just a couple of minutes back, I had commented this, right? Saying that a saving in a particular category does not mean you invest in a particular category.
Exactly.
You would probably invest in saving somewhere else, in any other category.
Yeah. That I agree. completely. Yes. No, I think we're
also remember that stock prices have moved very differently. Maruti had moved ahead of this particular announcement quite materially. It was below 12,000 rupees just about a month back.
That is true.
So
that is true.
Think of that fatigue as well, right? And
no, absolutely.
Had not moved much 2 weeks into that previous GST announcement after the Independence Day. So maybe that is the other aspect to look at it. Plus, this incremental thing is tractors also have happened. So that is also playing more as a positive sort of a spirit.
No, absolutely. And everything doesn't need to happen on day one. When you take that point, I mean, the manufacturers themselves have told us, right? This will eventually play out. They'll ramp up their production and they'll see what the debate that you and Prashant are having, I think we'll have exact clear answers within 2-3 months on whether the customer behavior starts changing, because the headline number of that particular vehicle itself is down by 10%. But I just want to get back to the point on financials. Whether we should look at beyond something like a Bajaj Finance, whether we should look at banks differently. Do you expect a leg up in financing to show up? And if yes, across what kind of lenders?
Yeah, I mean, honestly, the financial sector is in a situation where credit growth has been fairly weak. In fact, deteriorated all through the beginning of this year. As you see the second half of the year, there are clear positive signs of why credit growth should improve. We're essentially seeing a lot of liquidity come in the system. And more importantly, I think the regulatory system is more or less keen on pushing up consumption leverage back again a bit at least, or leverage in the economy a bit more, right? So these are all positive signs. You want to play it through a bank, you want to play it through a pure play durable lender, or you want to play it through, let's say, even things like affordable housing companies. It's across the board. You could pick and choose where you're more comfortable from a valuation standpoint. See, I'm on an overarching basis overweight in financials, apart from my consumption overweight here and there. And as you know, I'm underweight industrials in other areas. So I would be probably playing a bit of financials as well from a standpoint of leverage.
And which category? I mean, spell it out. You just named a couple of them, right? But where is it likely to show up the most? Specific niche NBFCs catering to consumer housing, where would you really expect the impact to be?
Exactly. The consumer parts of each of these entities. Some companies would be more, NBFCs would be a bit more leveraged to that. So they'll probably benefit a bit more than an overarching large bank, which is doing a lot of other things. But then my call in financials is not purely linked to GST and consumption. It's more led with overall credit growth improving from where we were earlier. So it's tough for me to, remove myself from that broader thought process of overall credit growth and not just consumption-led credit growth.
So financials, right, where economy, the financials are lenders, they're economy-facing, and so you don't have to choose. I don't know, you can't pick stocks, but I'm saying something like Bajaj Finance, right, consumer lender. I'm assuming with exposure to multiple sectors, but on the consumption side. So it should show up in those kind of names.
Yeah, I mean, look, it's all about relative growth as well, Prashant. So if something is growing at 25, it goes to 27, does it really lead to much impact versus something growing at 8, 10% credit growth going to becoming 12? I guess the impact is much more for that, right? So, so you can't basically take a particular stock and say the impact
I
is only
must
going to be
say,
on them.
you're being very cryptic today. We'll need to, we'll
I wanted to avoid
You're saying
giving
this and that. So, but anyway, we'll leave it there and we'll talk again and come back and we'll talk again. We've got lots of GST companies to talk to as well. Appreciate your time here as always, Venu. And thanks very much for joining us as always. So that's Venugopal Garre, Bernstein, with his perspective.